The CFPB was even clear in their comments that they are okay with a little more friction if it keeps users' data safer. Those aren't opposite. You can do both, but whatever. I don't run the CFPB, you guys.
Welcome to Affiliate Marketing for Lenders. I'm your host, Carlos Caro. Banks spend billions of dollars per year advertising in affiliate channels. It's a complex, high-stakes game, and I'm here to guide you through it. If you're a lender that wants to grow your affiliate program, you're in the right place. Let's dig in. Today I'm sitting with David Nohe, who's the CEO of FinGoal. On the company's LinkedIn profile, David describes FinGoal as the hyper-personalized insights and offers platform atop of bank and card data. Your offers 10x better targeted to users. In addition to his focus as a fintech entrepreneur, David holds a JD from the University of Maryland, and he uses his background to talk about how the regulatory landscape impacts the fintech community. Recently, he published a piece on LinkedIn called The 10 Takeaways on 1033 for Community Bankers. He's also recorded podcasts on the topic of the CFPB Rule 1033. Given our recent conversation with Tim Hong at MoneyLion and a piece I wrote about the challenges I expect cash flow underwriters will have with their distribution, I thought it would be great to get David's perspective on how he thinks Rule 1033 will impact bank marketers. David, it's great to see you. Thanks for being on the show today.
Carlos, absolute pleasure. Thanks for having me.
I know you just came off a flight from the Money 2020 conference, so appreciate you joining us so early on a Thursday morning here.
Oh yeah, no problem, man. No rest for the wicked.
Awesome. So we want to spend kind of the first part of the show today talking about 1033 and the CFPB rule that just came out. Our audience is primarily bank marketers. So can you give us just a 60-second TLDR on what is this rule and how is this relevant to bank marketers?
Yeah, for sure. So 1033 is codifying how and who can access user permission financial data, primarily focused on consumer deposit accounts and cards, whether that's debit or credit cards. Those are all in kind of in scope. And so think of it as regulation for what Plaid and Yodlee and their ilk do and anybody who uses them. Banks now have to share the data when the users want the data shared. And then there's a bunch of safety requirements on how those of us that are on, say, the marketing side as recipients of that data, how do we have to keep it safe? What does the consent look like from a privacy standpoint? But it's great. The market's growing up and we see it as a good thing.
I talked to a lot of cash flow based lenders who use this
Sure.
kind of open banking data on their back end underwriting policies. What changes for them in the context of this new rule?
They're probably the most impacted. The CFPB has been explicit about wanting to encourage more cash flow underwriting to open up access to lending for more consumers in this country, right? And you think young, you think new to America, but just generally thin file folks, right? And cash flow underwriting makes that possible. And so if that's the business that you're in, these are really, really good tailwinds because banks now have to give you the data that consumers have and that some banks anyway have been trying to keep locked down and adding friction or keeping that data from third-party partners like many of those sorts of lenders that you're talking about.
Got it. If I'm one of these cash flow based lenders, and I've seen PNC as an example in the news. I don't know if that's right or wrong, but PNC has been an example of someone or a bank that has kind of guarded their data a little bit more than others.
Absolutely. Yep.
So let's use that as an example where I have an applicant that has a PNC deposit account and they're interested in my cash flow based product. In the old world, PNC may have blocked that API and said, nope, I'm not going to hand over so-and-so's information. And therefore I became ineligible for that product. Is what 1033 is doing now, it's essentially requiring PNC to partner with me and to hand over the data so that I can use it for my underwriting. Is that effectively the difference?
That's exactly right. And PNC and Capital One were the two big names that have been tough on this for the past couple of years, and they don't get to be tough anymore. As of April 1st, 2026, they have to share that data with the sorts of lenders that you're talking about.
Gotcha. So 18 months from now, these cash flow lenders basically open up their
Yeah, that's
audiences, like
exactly right.
who they're
That's
able to lend
exactly
to.
right. Yeah,
Gotcha.
that's exactly right.
Cool. So I'm starting. I spend a lot of time working with affiliate marketplaces, folks like Credit Karma, Experian, Credit Sesame, folks in that category, and they for a long time have been using credit bureau data to target ads on lending products, credit cards, etc. And it creates for these really good user experiences where I log in and I'm only seeing ads for products where I'm going to get approved, essentially, with a very, very high likelihood. Call it 80-90% likelihood. It's been challenging for these cash flow based lenders to market in those types of environments because the publisher doesn't have that open banking data. They don't have access to it. Does 1033 change the game for these affiliate distribution partners?
I think it depends on how the data is getting to the marketplaces. So
Okay.
the good news about Credit Karma more recently, but Credit Sesame for years, Experian starting maybe about 18 months ago, is they've already been collecting open banking data, right? Even before the regulations were finalized. And you need to have that data up front in order to target more effectively, right? But if you're getting that data up front and you're getting consent at scale from the user base to use that data for credit underwriting, for example, then you can have a marketplace that is effectively just as good. It'll take some, a maturity cycle, but it'll be just as good as what you can do with the credit report driven offers. But I want to go back to what you said about the existing kind of successes that we're seeing with credit score focused offers, right? The current success is happening because the offers are only being put in front of potential applicants or leads that we'd have a high confidence are going to qualify for that loan, so that you're not wasting time or money advertising to an audience that isn't going to qualify for the product anyway. And that's super cool. But 1033 gives us an opportunity in that market too. It allows us to not just market to the applicants that are going to qualify, but to better target to the applicants that want and need the product in particular, right? So let's use credit cards, for example, right?
Mm-hmm.
Different types of credit cards have different sort of jobs to be done by the end customer, whether it's a travel focused card, whether it's business expenses, gas and groceries, et cetera, et cetera. If even those lenders that are credit score based can now better target one credit card or one reward system from a credit card to the right customer, because you now have visibility as an advertiser to where a customer or a prospect spends their money and makes their money, right? That's really where the magic comes in. So this is good not just for the income-based underwriters. This is good for the entire ecosystem that's trying to put more relevant offers and next
Mm,
best actions in front of their users.
got it. Yeah. So playing that back, the data I gain access to through 1033 helps me not only if I'm a marketplace, it helps me not only get comfortable that this person's going to get approved for a product. We can check that box, but it also helps me make a more relevant recommendation because I know you're spending in these categories and how much. So when I put that card in front of you, I can say, look, I'm recommending this to you because I think you'll earn $300 more in rewards. And I can actually probably contextualize that recommendation based on like your spending data.
That's exactly right. That's exactly right. Or here's like a really simple example. Advertising this, it's the same product, let's say a HELOC, right?
Mm-hmm.
So let's say you've already done the pre-qualification, sort of you're focused on folks that will be approved. But advertising that same HELOC for one party that might want to use it for home improvement and another lead that might want to use it to travel the country, right?
Mm-hmm.
And those are two very different things to use that financial product for, but it's the same financial product that you're trying to drive leads to, right? But now that you can better predict why the customer is going to want this product, you can again better target them and put better copy and better creative in those offers.
Got it. Okay.
Yeah.
And let's talk consents here for a second. And again, I'm
Yeah.
not a lawyer. I think you have lawyer
I pay
you
my bar
you
dues
you
every summer. I don't know
you have
why.
legal
I
training.
haven't practiced in a long, long time, but I still pay my
Yeah.
bar dues.
So you're gonna know more about this than I will for sure. But let's talk about consumer consent here for a second.
Yeah, for sure.
How explicit does the consent have to be? So like walk us through like what does that say, and how often would it have to be renewed if I'm a marketplace that's looking to use this information?
Yeah, let's take those in two pieces. So one is what kind of consents need to be received or need to be gotten by the customer. So number one, all of the consents now have to be opt-in. There's no opt-out. There's no hiding it in the small print or everything is a yes, yes, yes in a table. None of that. Like that's all gone. Not unlike what we've had with credit data in the past. The uses of that data have to be explicit. So, for example, if I am collecting your transaction history in order to underwrite a loan, if I'm also going to use that data to cross sell you on other products in the future or for potential second look offers, right? I need to get a separate consent from you to do that. Think of it from a UX
Hmm.
standpoint. I'll use files that are here handy because I've got the things
Okay.
that are on the wall just right here on the table. Okay. So let's use this as an example that everybody can sort of mentally visualize, which is you are logging in. Most of us have used a Plaid or a Yodlee to link our accounts in the past. So you log in with, let's say, your PNC or Capital One bank info to apply for a loan. Cool. Right after you put in your name and password, you see a window that says, hey, you're sharing your transaction data, descriptions, dates, amounts, etc., for 30 days, 90 days, up to 12 months, which is the cap, with this partner in order to apply for a loan and determine your eligibility for it. Cool. You say yes. The next window pops up, sort of the next step in that sequence, that then says, hey, can we also use your data to match you with money saving offers, see if we can save you on interest rates, earn you more in your deposits, et cetera, right? I think the only way that users are going to say yes to these second uses is if you are clear about the value that they can get from it, right? Help them earn more on their deposits,
Hmm.
pay less in their lending, if they're refinancing, or get access to capital, or save money at merchants, whatever it might be, right? But you
Got
have
it.
to show what that value is so that they click yes instead of no. But that is okay, right? You can ask them at that same time,
Hmm.
but it's like one extra window or modal in like UX world and a yes or a no, and then you're good. And that data, again, you also ask them how long they're going to share that data with you, and the
Hmm.
cap that the CFPB has put on it is 12 months. And then we can talk about in just a minute what it means to renew those consents on a
Got it.
recurring basis. Yeah.
Got it. So in the context of a personal loan marketplace or a credit card marketplace, let's say I'm Experian for a second, okay? And I get that consent. And the consent sounds something like, hey user, I'd like to get your PNC data into your member profile so that when you log back in, I can recommend relevant products that you're going to be approved for. Okay?
Yep. That's exactly right.
Customer says yes, sounds like that's good for 1 year. Cool. However, if I'm Experian and I want to get that customer into I'm making this up, a Chase loan or a Chase credit card because I believe that's the right fit for them and their spending pattern and all of that. I think what I'm hearing is in that flow, before I hand over to Chase, Chase is going to need to get that same consent as well before they underwrite that consumer if they're going to need that 1033 open banking data to
That's a
underwrite.
really, really good question. And I don't think the CFPB's got enough credit for the way that they've laid this out. So they were pretty clear with what could think of it as multiple third parties that sit on top of the same consent.
Okay.
And in some worlds, like in like a lot of the European privacy models, you one third party cannot sit on top of another third party's consent. You can't kind of delegate access to the data to serve a purpose. You have to have every single party needs to be explicit. Fortunately, this model does not do that, which I think is great. It allows you to share data with one bureau, and then if you need to share it with another, you can. If you have, let's say, you are looking at multiple credit underwriting models, right, from different vendors, and you want to back test, you want to do that kind of stuff, all of that is acceptable. If you have the consent to use it for you, you can use those same consents with a third party. There's a documentation trail, et cetera, that you
Mm-hmm.
have to do, but the user does not have to consent for that use a second, third, fourth time just because you have subcontractors or you have affiliates and things like that, which is a
Got it.
really, really big deal. The other consent thing, though, that I think is really, really important is why is the user sharing the data? And is this, especially when we're talking about marketing and cross-selling, the CFPB
Hmm.
gets really nervous there, right? They're excited about income-based underwriting. They're nervous about cross-selling. Okay, those are very much the balance here.
Sure.
And your audience seems to like also be in that balance of being excited about the
Hmm.
underwriting, but hey, it only works if we can market to them. So they actually like give the example of products like NerdWallet, where the whole product is about helping you optimize what cards are in your wallet, right? And
Yep.
so they can essentially have cross-sell consent as part of like as core to why you're sharing the data with them. So almost in a
Hmm.
contract of adhesion. It's like if you want to use NerdWallet in the kind of credential personalized way, you have to share this data with us. And that's okay, because that's why they are there. But let's compare it with something like Experian Boost. The core product is to increase your credit score. So they're going to
Hmm.
share data so that your patterns of paying your rent and insurance companies and Netflix, et cetera, can go in and they can see that. Cool. That's the core of the product. If Boost wants to use that data to also cross sell to you, they have to get a second consent from you, right? They can share the output of that consent with their partners, but they are going to have to get that second consent, like we talked about a little earlier. Does that make sense?
Got it. Yeah, it does. Can those two consents be wrapped into one modal that a customer reads and checks two boxes, or are they like separate legal agreements?
It's unclear right now. The path that we're recommending is to do it as a second modal and to again add value in that second modal and be very clear why the user wants to do this so that it's a good thing. The CFPB is not as clear on that as they should be, and they're kind of leaving it up to a handful of industry run standards bodies
Hmm.
to figure out the best practices for the UX there. We're not going to get into all the data standards stuff, but the industry
Yeah.
is working on kind of having a consistent set of how those consents should look for everybody. Um, just like we saw with like credit card consents and credit data, 25 years ago. But it's a really really good question. I do think though that products like Boost, if we want to stick with that, or it probably goes to a Credit Karma or Credit Sesame is in that same ballpark, where you can say, hey, our core product costs $10 a month, but we'll give you a $3 a month discount in return for consenting to this. And that consent you can renew on an annual basis. And if they don't renew it, the price goes up, right? So especially for products that charge something, but
Hmm.
so they have room, they already have automatic billing, et cetera. There is room for there to be a clear exchange of value where the user says, okay, I pay less, I get a discount, I get a credit in return for sharing my data. CFPB is very okay with that as long as you're clear about what's happening.
Interesting. I had not thought about that use case, but it makes total sense.
You know a lot about the space. Where do you see that going, right? Because nobody's really doing it that way today. But knowing the players, like what's your read on that kind of model?
Yeah, so I think the subscription type models are, I mean, based on what I hear from friends in the industry, I don't do a lot of direct business with folks that are in that use that model. I mostly work with affiliates that give their products for free, so like the Credit Karmas of the world, where it's a free offer, and the value exchange is, yes, I'm giving you consent to pull my credit, but in exchange for your right to pull my credit, I see my scores for free. I get recommendations on products. Like I get a whole bunch of value. So they tend to be barters more than like purchases is what I see most of the time. Um, the question that keeps coming up for me when it comes to consent here is that like affiliate marketers are obsessed with eliminating friction as much as possible. So that's how a lot of these marketplaces are built, around the premise of the least amount of friction is good, right? So if I can use your credit data to tell you that you're going to be approved at a high rate, and furthermore, if I can pre-fill your application and send your application through an API to the lender and tell you on my platform that you were approved and your credit line and all of that, that's the best possible experience because it eliminates all the places where people usually drop off. I look at this consent and I'm wondering, well, how many people will, like, what percentage of folks transact, like, on the market for a new loan product are going to agree to this stuff? And even if it's a 20% drop off, that's meaningful in the
That's
context
for
of
sure.
these businesses. So like, do you have a POV on what the success rates are going to be for these sorts of consents?
So it's wild. Some of the industry standards bodies have done pretty targeted A/B tests on different consent flows, and adding an extra modal or two actually increases conversion, which is totally counterintuitive, right? I would have never expected that. When I heard that, I was like, let me see the reports. Let me see what happened here. And they also had higher like user satisfaction ratings. Like, oh, I understand what's happening here, right? If a user is saying, hey, match me with the loans I qualify for, and you're
Mhm.
using that data to also do income-based underwriting, that's going to be okay. That's why the user's sharing their data in the first place. The user's highly incented to do it, right? So I don't think you're going to see any drop off there. You're just going to see more access to more data because the banks aren't going to be able to shut it down anymore. On the secondary uses, right? It's, you want to sell them something in the future, right? That's where we don't have, I think, enough data about what those conversion rates are going to be. And I think why the exchange of value by the platforms upstream are so key, right? Because again, if the platform itself, where the marketplace where the affiliate offers are being furnished, if they're getting the consents up front in an exchange of value, and that exchange of value could be dollars, like I shared, but it could also be, hey, we're going to match you with offers that save you money, right? Or give you access to more capital, whatever. So not just for underwriting, but all for matching, right? And their users are already highly incented and motivated to get good offers because that's why they're on these platforms, right? I think you're going to see really high conversion. And most of this is data that we're not using today. So is the opportunity as big, like opening up as big as what it is with credit scores? Maybe not, because there is going to be more friction than we have on the credit score side, no question. The CFPB was even clear in their comments that they are okay with a little more friction if it keeps users' data safer. There's aren't opposite. You can do both, but whatever. I don't run the CFPB, you guys. And broadly, I do think they did a decent job, but we can't all get what we want. If you look at this as mostly greenfield opportunity that's coming in, that's a really, really big deal. And sure, you're not going to necessarily get the same data conversion rates that you get with credit reports for the purposes of income-based underwriting. But for the folks that you are getting the data for, and it's going to be the vast majority on the marketplaces you're talking about, you also get better segmentation data on them, right? Better attributes about them because you know this week how they're spending their money and making their money and where they're spending their money. Your conversions are going to go up, right? So, yeah, it might be top of funnel is not as exciting as what we can get from the credit bureaus, but I think the funnel will be wider as it goes down, right? Does that make
Got it.
sense?
Yeah, no, it
Okay.
does. It's surprising though. I had the when you were when you gave me the headline, my reaction. People can't see my face here, but I was like, "What? How is conversion going up here?" So the core idea I think I captured is when you give the consumer the consent, they're actually like the promise of value that you're offering is strong enough to more than offset the friction you're creating. Is kind of
That's
what I
exactly right. That's exactly right. And this is net new data for the most part, right? So if we're looking at it as net new data, excellent. What we don't know yet is will the conversion funnels be the same shape for income based underwriting, for example, as what we have for credit score based underwriting. We just don't know enough yet, right? But the for both types of loans and other products, of course, getting the additional user segmentation data
yeah.
because you now know where they spend their money and make their money, like where are their
Mhm.
merchant loyalties, for example, right? Things that you can't get from a bureau, not from a credit report. And the sort of rolled up data that you get from bureaus is tends to be educated guesses nowadays.
Yeah.
It's just like, oh, this user looks like somebody who would have these affinities rather than knowing that they have these affinities, right? And so the result is the credit bureau's attributes make everybody on the same block kind of look identical, right? Like me
Yeah.
and the dad next door to me on my block probably look the same to the credit bureaus. But I promise he's an accountant, really nice guy. I'm a founder. Our buying behavior is very, very different, right? Even if our credit scores are both great and we both drive Subarus, other things about us are very, very different, right? And advertisers would like to be able to know that and target us that way. And I don't like irrelevant ads. I don't know about you, Carlos, but I don't like,
Right.
wasting my time.
Yeah, yeah. No, so I mean, this sounds like really good news for affiliate marketing, for the
Absolutely.
publishers. Like, I think they would probably be willing to introduce friction in exchange for just the quality of the data and the improved recommendations that they're going to get. But if they're getting improved recommendations, more data, and higher conversion, because now the user trusts them more because the consent has been placed, that's like a compounding win. So that's
That's exactly
really
right. That's
really
exactly right.
exciting. And then from the lender's perspective, they get more distribution as well. So I think it sounds like all parties win in this model if that's how it plays out.
You know what's really interesting? I think publishers have a bigger win here that I hadn't thought about until you just kind of framed it up that way. Right now, publishers are sort of just a conduit to get data from the credit bureaus, and then they have audience, right? Now, though, with open banking, they are the holders of a lot more data from that audience. So yeah, they still have the digital real estate. That's great. They still have the audience itself. But rather than simply being a conduit for data from the credit bureaus, they are now able to hold their own data about the user's financial behavior. And they can run their own analytics on top of it, right? For, say, segmentation, their own A/B testing for copy, all that kind of stuff to optimize offer conversion and just better, more personalized UX, right? And it's really, really interesting for publishers as yeah, I think that's really powerful for them. Cool.
Well, we'll see. I've heard this argument from more than one lender that says, yeah, my friction's actually revenue increasing. I've heard this line of argument, or I've heard that
Yeah.
line of reasoning before. Sometimes it works in practice, sometimes it doesn't. So
Yeah,
I'm cautiously optimistic on that, but I'm inclined to wait for a little more data until I'm broadcasting that
totally.
that's how this is going to play
Yeah.
out. But
I think that's
that's
fair.
certainly
Absolutely.
encouraging. As I was preparing for our conversation, David, I was looking in kind of the ecosystem of opinions of like, hey, what are other people saying about this rule? And is anyone concerned about it? Is anyone worried about it? And I bumped into a couple observations here from some folks. I want to bounce off of you to get kind of your personal opinion. So the first is from the American FinTech Council, a gentleman called E.N.P. Maloney. He's the senior vice president and head of policy of regulatory affairs. He said that while the trade group appreciates the monumental effort to establish a robust open banking framework, that they were deeply concerned about the Bureau's decision to finalize the rule without considering and revising provisions related to the secondary use of data for cross-selling financial products and marketing. So I look at this and it reads to me that they're suggesting that the rule the open banking data that the rule contemplates cannot be used for cross-selling and marketing. um does that sound right to you? And if not, like, what do you think Maloney's concern is here?
Oh, Maloney wanted the same thing that we wanted and your audience probably wanted, which is guardrails that allowed secondary use like cross-selling to be embedded in primary products. So I want a product that helps me improve my credit score, also help me get matched to loans, like say refinance loans that save me money, or um, if they're noticing that I'm paying too much for Netflix and they give me the offer to reduce my Netflix subscription by adding T-Mobile or something like that, right? That's good for the consumer. A consumer, you don't know what that is, what that match or what that advice to the end user is until you're allowed to look at the data for the purpose of giving them those secondary pieces of advice, which are, yeah, it's cross-sell promotions. That's okay, right? And so the industry, like fintechs and folks that market through and partner with us, that's what we hoped to see happen because we see how that's a better, more seamless user experience. And as I shared before, no, the user has to say yes to that explicitly as a second reason they're sharing their data. It can't be embedded in the first one.
Got it.
And yeah, it is what it is.
Got it. So it sounds like what you're saying is the top of the funnel, kind of the eligible universe that marketers can talk to in the context of using this data, is
Hmm.
limited to just the pool of people that have explicitly consented.
Yeah, that's exactly right.
Okay, got it. Okay. So I can't go use this for like direct mail. I can't go use this in Facebook advertising. I can't go to
Not unless the
Google
user has
unless
consented
the
to
user has
cross-selling,
consented.
right? They don't have to
Right.
consent, Meta versus Google, right? Or direct mail versus email. But the idea that you're going to target them with promotions or content, they have to say yes to that.
Got it. Yeah, no, so I totally get the concern here then. It does limit kind of the scope of how broadly the data can be used. But it doesn't sound like cross-selling is banned. It's just, there's an opt-in required before it can happen.
That's right.
So
Yeah.
okay. All right. So the other piece I bumped into, so apparently there's already litigation over the rule. The rule hasn't been out that long, but this litigation I read about landed the same day the rule was released. So you got to wonder if they even read the rule. It's like 600 pages long. Um, but it came from the Bank Policy Institute, the Kentucky Bankers Association, some other banks here, and according to the Bank Policy Institute, the CFPB exceeded their statutory authority and violated the Administrative Procedure Act in various ways. And according to the complaint, the rule, and I'm going to go through these fast, requires no oversight of third parties who are using the customer banking data, thereby leaving it up to banks to ensure the protection of sensitive information, increases the likelihood of frauds and scams, does not outright eliminate unsafe practices such as screen scraping, does not hold third parties accountable for data securing, allows third parties to profit at no cost from the systems built and maintained by banks, and imposes an unreasonable implementation guideline. Okay, so that's a lot to react to here, David. So I'm not going to ask you to go here one by one. My question is the following: like, what do you think the impact of this litigation, and I imagine there's going to be more like this that come up over the next several weeks. What do you think the net impact of all this is going to be on the final rule?
I think it's going to be a nothing burger, candidly. Just to be real. So a lot of the smaller banking associations, and I've debated with them plenty over the past year as they put in their comments during the comment process with the CFPB, are anti open banking full stop. And regardless of what they put in their lawsuit, there's two reasons for that. Number one, they are nervous that data leaving their walls will be used by competitors to take customers from them, right? And so it reduces their moat to keeping their customers, right? And anybody is going to legally fight when they feel like their moat is being reduced.
Right.
Um, my counter to that is kind of twofold. One, build better products. But the bigger one, though, is every bank can also be a recipient of data from other banks. So instead of seeing yourself as a victim, put yourself like the best defense here is a good offense.
Right.
You go out and go get business from your competitors, right? Because now new customers can share their data better, and you can put better products in their hands. Another second, I just published a white paper on this last
Mm.
week, and it's 10 things that community bankers need to know about 1033. Might not matter for marketers, but here's a really interesting thing. As part of like in the weeds of 1033, now as a bank, when my user's data is being shared to a third party, because it's happening over my APIs as the bank, I know where my data is being shared and for what purpose. It's part of the specs. I have to know who's getting the data and what they're doing with it, right?
Hmm.
There's nothing preventing me from using that to cross-sell, upsell, white glove my own customers. I can use that to better predict churn, right? If one of my highly profitable customers just shared their data with the bank across town, an alert should immediately go out to one of my bankers to pick up the goddamn phone, right?
Right.
Whereas today, if they just went across town and it's just a credit pool, you don't know that that happens, right? You have no visibility to the fact that they're talking to the competition. Now you do, right? So I think that's a really, really important point. The
Hmm.
other reason banks are nervous about this is just cost, right? Anytime they see new regulation, like, damn it, there's another line item that I have to pay for, and I don't have a choice about this. When it's a regulatory required service, vendors know that they're going to
Hmm.
charge me. They're going to charge top
Right.
dollar for it. Yada yada yada, right? And what we're seeing in market though is a couple of things. One, most of the bigger banking vendor, core and digital banking vendors are just including this as part of their standard set of features, right? So when they're doing new RFPs and renewals, they're just including it, or it's a negotiable thing. I don't think that base compliance with 1033 is going to be a large revenue driver for platforms. Instead, not all platforms have 1033 compliance today, and the ones who do are going to use it to try to win more deals, pure and simple,
Got it.
right? The other is it costs money today to be screen scraped, right? Especially for smaller banks that don't own any of their stack. If you're getting hit by a Plaid screen scraper 1,000 times a day per user, which is real, that costs you money. That costs you calls, it costs you authorizations, etc. Your bills are higher, and it's a huge freaking risk that your users' names and passwords are being saved elsewhere. And you don't even know, you know that it's Plaid, but you have no idea why the data is going somewhere, and you don't know who Plaid is sharing it with. But that all changes now with 1033. So I get to sort of like being nervous about change. I think that this is broadly a good thing for banks that choose to use it as an opportunity and use as an opportunity to grow and be more competitive.
Yeah, I think you put it perfectly.
Sorry, I got on my soapbox there. Sorry
No,
about
no,
that.
no. I love it. I love it because I think I think you hit on something important here, which is if you're a bank that's relying on inertia to keep your customer base, your products aren't
Yeah,
all that good, you have some
bingo.
kind of privileged position, and you're fundamentally on defense. This is
Mhm.
scary. This is threatening. If you're fundamentally on offense, you have great products, you have great capabilities to acquire new customers. You should be excited because this is just adding to your toolkit, right? So,
That's exactly right. And so here's an
yeah,
interesting
yeah,
thing for
yeah, yeah.
marketers so prediction of where I think the market's going to go. The CFPB said, hey, banks, you can't charge for access to this consumer data. However, there's a whole bunch of data that's not scoped in by Rule 1033 that banks can charge for. So think like business account data, um, loan behavior, brokerage accounts. Like basically, if it's not a deposit account, a consumer deposit account, or a consumer card account, that's premium data that is an opportunity for institutions to charge for. Right? The market does not do that today. Right? I absolutely see that happening. If I was building software to help banks
Mm.
be compliant with it, my wedge would be I'm giving you this monetization tool, and like we help you set the prices of all of that because we know what the market will bear, and you just get this great non-interest revenue stream, which is what every bank wants, is just additional streams of revenue, right? So turn this again from a cost center into a profit center. But anyway, that's just a prediction. The market's not doing it yet, but hit me up in 12 months and I will gladly buy a real nice dinner if I'm wrong on that one.
All right, I'm gonna write that down and I'm gonna mark my calendar, and you'll
Do it.
we'll chat about it either way. We're running up on time here, so we have a few more minutes, but I do want to take a step back because we started off this conversation a mile deep in 1033, and I know you have a legal background, but why do you know so much about this rule, and how does it relate to your role at as CEO of FinGoal?
Yeah, sure. So for folks that aren't familiar with us, FinGoal is in the business of better understanding account holders and end users based on how and where they spend their money and make their money. So deriving attributes and signal from folks' transaction feeds. It's that simple. We build matching algorithms to next best actions at the classification of product level, like, hey, a personal loan versus an auto loan, and then very specific, like this loan or this product versus that product is a better match and a higher conversion prediction for this user, right? So that's the business that we're in. So, which is to say, our fuel is two things. It is offers and actions, so the entire kind of corpus of things that an end user could do, and then the transactions themselves. Most of our customers today are banks and credit unions. We have 150 customers, 125 of them are banks and credit unions. And we can do everything we do on the data that those banks and credit unions have in-house because that's not covered under 1033. 1033 is only data that's coming in from third-party FIs.
Mm.
But my job is a hell of a lot easier when I can access held away data, right? Coming in from those other financial institutions. And so whether I am making a marketplace smarter or I'm making a large bank or credit union smarter, The more data, the more transaction data FinGoal has, the better we can do our job. It's that simple, right? So we've been really close to this for a long time. I'm active in there's a industry standards body called the Financial Data Exchange that kind of is writing the API specs to be compliant with
Hmm.
1033. I've been really active there for a few years now. But yeah, it's a place that we've been doing this for a little over 5 years, and we've been close to open banking data for that whole journey.
Got it. And it sounds like in reading about FinGoal, one of the use cases you all have is helping banks cross sell more effectively. Can you walk us through like a really simple use case on how your business helps banks with cross sell?
Yeah, absolutely. So let's say that I have a user that is spending more money now at the mechanic and at the auto parts store. And I also know that they are giving money to Sierra Club and Greenpeace, and they shop at secondhand stores. Not only were we able to identify that they're probably going to be in a market for an auto loan soon, we're going to predict that it's going to be for a used Prius. So now the copy and the creative for that offer, regardless of who the lender is, whether it's the first party lender or if it's a marketplace, gets all of those attributes of what we know and predict about the user so that they can more highly target and personalize that offer. And we see
Gotcha.
cross sell conversion rates increase by 300 to 400% after we come in.
That's awesome. David, if folks want to learn more about FinGoal, what's the best way to contact you?
Yeah, sure. You can find me on Twitter or X. You can find me on LinkedIn. David Nohe, Nohe, as in no, he didn't. Or go to fingoal.com. But I reply to all my DMs, and I'm easy to find.
David, it's been a pleasure. Thanks so much for the 101 on 1033, the implications for affiliate marketers. Really enjoyed this conversation, and we will be following up in about a year's time on that dinner bet.
Sounds great, Carlos. Thanks for having me, man.
So that wraps today's podcast. If you enjoyed the show, the most direct way you can support the podcast, if you're a lender, is by checking out New Market Growth. We're at newmarketgrowth.com, and check out our services. The other ways to support the show are simply by sharing what you heard today with a colleague on social media or with a friend. Thanks for spending the time with me here today, and I'll see you soon.